Hello, and welcome back to another episode of Fun Friday with a very special guest today, the founder of Think Outside the Stocks, as well as a new group, which we're going to talk about today, Connected Capital. Please welcome
Mhm.
to the show, Madhavi Jain. How are you today?
I'm doing great, Greg. Thank you so much for having me. I'm excited about our conversation today.
I am as well. And just so I make sure that's clear, did I pronounce the name correctly, first and last? Because it's very important to do so. So I want to make sure that I did.
Absolutely, you're spot on.
Good, good, awesome. Well, thank you so much for coming. We've been connected for some time, no pun intended, of talking about, equity for, fund managing into our deals. And I think what you have kind of cooking on right now is super, super topical for the space right now on two fronts. So, connected capital is one end, and also kind of the fund management, fund to fund process as well. But before we get into that, I would love just for the audience to know and learn a little bit more about you, your background, and how you got to where you are today.
Thank you, Craig. Yes, we have quite interesting topic to talk about in a little bit ahead. But thank you for asking about my story. I quite often say that I have a very uncommonly common story. And the reason I say that because, there's bits and pieces of my story, your story, we kind of resonate with each other. And that's really important because if all of us could go through it and do that, then people listening, they get a little bit inspiration in that. So I really like to say that we all have quite quite a unique story, but commonly uncommon story as well. So I came to this country 9,000 miles away from my roots, with two suitcases and a couple of hundred converted dollars with my husband. We built ourselves from scratch in this country, had kids and home, car. It's like typical American dream, right? There's kids born in this country, they are citizen. We suffered a lot of immigrant visa issues, but they didn't. Everything was going on fine till 2008 happened, and 2008 was quite interesting actually for us. That's when me and my husband, both of us, by the way, worked for one of the top five consulting company at that time, and both of us got to know that both of us have lost our project. And when we say project, that means in a couple of weeks, if we don't get another project, we lose our jobs. So that's what happened in 2008. And this is the time when I was about to give birth to my second child. So that was really, really challenging, right? We moved from California to Austin, and we kind of rebuilt ourselves again in Austin here. And in Austin, again, I've always worked with one of the top five consulting companies, about 15, 16 years in IT industry. But in 2015, very interestingly, with my health, with my personal reasons, I had to kind of pull that plug and, from underneath my rug, from my feet, that I had to stop working. And when I had to stop working, then, of course, you still have the education on mind. My daughter was a middle schooler, and I'm thinking there that, hey, I need to support that. I don't want her to be choosing her college education based on what we can afford with one salary. And that's when I kind of started in a reverse way. Typically, people will leave their corporate job and then, sorry, can I say that again?
Hmm.
So yeah, so typically people, have the W-2 income, create that partial or full kind of an income, and then leave the job. But for me, it's the other way around, that I left the job and now I have to recreate that, right? So that's when I started dwelling in real estate. And typically by IRS code, rental real estate is a passive real estate. And I realized that there's nothing passive about it as I became a landlord, right? Quite accidentally, I came across multifamily syndication. Completely different world for me, completely new world for me. They didn't even know what multifamily means. And even now, people get confused with the word multifamily. It's simply apartments, right? So I found out about it, and I also found about infinite banking strategy. When I found about the infinite banking strategy, and that, hey, it's built on a whole life chassis, and you kind of, push a lot of money in there, and it kind of grows compounded, tax free. And then there's real estate on one side. So I was super skeptical about the infinite banking, quite honestly, and I was very pro for the real estate syndication. And when I'm in both those mindset, I go back to my friends, my numbers, my spreadsheets, and I evaluated, create different scenarios, especially with the infinite banking, because I was very skeptical about it. So that's when I realized that this actually work individually, but in unison, it works even much better. And when I realized that, and I kind of was excited about it, but at the same time, I was very, very restless. I was restless that being a first generation immigrant coming to this country, not knowing what wealthy of this country do, and just growing through that IT industry to the corporate world where it's just, 50, 60 hours work week, raising two kids. I had no idea. I had no idea that what happens in the parallel universe, parallel world. So that restlessness is what made me form Think Outside the Stocks. And with Think Outside the Stocks, my passion is bringing the education, what I have learned in both these areas, and I'm a very people's person, and we'll get to it when we talk about connected capital as well. But that is what the impact that I could bring with this education to individuals' life, families' life, especially women in, bringing them in this finance. That's what I'm driven by. And with that, I'm on a mission. We think outside the stocks to change financial trajectory of one family at a time and thousands more to go. So that's about my journey so far.
That's awesome. Well, and I actually have a question before we get into the nitty gritty there. But infinite banking, I've heard that phrase a couple of times, but I've actually never really researched it or looked up. Can you explain maybe to me and the audience exactly what that is? Because I've heard it as kind of as a hot kind of button word. So I'd be curious to know if we could unpack that a bit.
Absolutely. So first thing, audience or you, and you have to remember that infinite banking and the investments are two different things, right? People often get confused about it's an investment. I would say that's a saving strategy. So when you're looking at your kind of emergency money, whether for yourself or for business, or typically like a bond portfolio that's secure and kind of, in the world of investments, we don't put guaranteed word to many things, but this is the thing that actually has contractual guaranteed return into it. And I'm not talking about, any specific life insurance, but it's a very specific life insurance product. What you could do is you can move two level of securities in there. One is that your emergency money security, and club that with your biggest asset, that's you, the security about your life. So you can club that together, put that over there. You can overfund it now. And overfunding is really, really key importance. Once you're overfunding it, what starts happening is that now you have that tax-free growth. It's growing compounded. It's not leaking money for the taxes. You're not taking that money out. And it's kind of growing compounded year over year. And so that your death benefit too. Typically, whole life insurance, the death benefit does not grow at all. So number one, you can contribute to it with whatever limit that you want. You can grow compounded and tax free. Now you can take it out or reuse it for any purpose that you want. So people typically like to invest, and the real estate investors, that actually is a best purpose for it. Without taking that money out, you can leverage from it. It's almost like your home equity loan, that you don't have to sell your house, but you can still access your equity. So now you can take that loan, take that leverage, and invest into something better. So that money is growing inside, plus that money, same money is invested as well, right? So it's called an and asset for that reason, that the same dollar gets utilized at two different places. And now you can repurpose and utilize that money for any purpose that you want. For example, I help people to put it into for education purpose, for retirement purpose, and you don't have to be tied to that purpose. If you don't use it for education, you can use it for retirement. Or hey, if you want to buy a vacation home with it, you can buy a vacation home with it. It's your money, and that's the security of it. And once I mean, during your lifetime, you can utilize that. And as a death benefit, it's an income tax free death benefit. So that's again added as an added advantage as well. So I always say that, when you say the life insurance has a word life in it, but it is technically, people think about it as a death benefit that I will never see. But this way, the life insurance you can utilize during your life for several different purposes. Hope that
Understood.
explains it.
Yeah, no, that definitely is a background and understanding for sure. And I always like to introduce new ideas and themes and concepts on the show. So this is the first time that's been introduced, and hopefully, more people will catch on to it and maybe learn and ask questions, and we can do another deep dive at another point as it pertains to that. So tell me about your first real estate investment and if you got the bug from that. So you moved obviously to Texas. You mentioned maybe it was single family, and you learned right away that being a landlord is quite anything but passive. So we'd love to hear that story.
So it's a tenant horror story, quite honestly. So here's what happened, right? One of the tenants, we just get call about something had happened, and we decided, okay, let's just go and visit it. So these people, they were hoarders, and end to end, this house looked like it's a dumpster. So obviously, we gave them the notice and we requested them to evict. They moved out, but after the move out, we literally, it was back to back from garage to garage. Everywhere it was just filthy, and there was so much junk in that house. We had to spend about $20,000 to bring this house to back its glory, that somebody can even start living as a tenant over there.
And how
And
long was that
this,
tenant in there for, by the way?
it was a couple of years, so it was not too long ago. But
That's crazy that how much someone could accumulate though in such a quick period of time. It's
exactly,
certainly
exactly.
eye-opening.
Yeah. And there was, so many violations in there. For example, one of the bedrooms had the carpet completely pulled out. So they were living on literally on the foundation with the nails sticking out all around. And there was a senior citizen in that room. So I was shocked beyond imagination to see that. But again, this is the kind of experience which deterred me from being a landlord over again. Of course, there's other challenges, but this kind of highlights the most. And that's when the syndication world, and it's not, I mean, when I suffer from something or if I get a knowledge of something, my tendency is that if I'm successful at something, I want to go and shout out from the top of my roof that, hey, this is what something that works well. And if I fail at something or I have lessons learned from something, I want to do that the same too, that, hey, this is my experience. Please do not make the same mistake. You can make this other mistake, but at least, I try to guide that don't make the same mistake.
Absolutely. Well, it's, very noble of you. So then you obviously go from the single family space, and then is that when you kind of learned about syndication? Did you take on some
Yes.
units yourself? Or did you realize, hey, I don't want to do anything with this property management and asset management business. I just want to leverage my money and have pros take care of it.
That's a very interesting question, and actually, that's where I was on the path, right? That for example, when I left my job, that was because of my health reasons. So I knew that acquisitions and asset management, being boots on the grounds and walking those properties and doing that is not physically possible for me. So I decided to stay in a lane. First of all, I started my journey as a passive investor. I started my journey with education. Neil Baba is my guru in this arena, but that's where I started. I started being passive first because then I could do my due diligence. I could ask questions. I could educate myself first before I started getting into active. I did participated in partnership and syndicated partnerships as really, really important, right? So I was an asset management team on that first property that I moved in. And I love this team. I love to work with it. I love to do the asset management, but it was just not, possible for me continuing. So I decided to I came to that fork where it was, should I do and go and do the acquisitions, asset manager, or be in the capital raise lane and still continue focus on my investors, because that's what my passion was, that and still is, that to focus on education, educate more people, bring that knowledge to their life. And that's when I decided to be on the capital raise lane, so that I could be that bridge, right? I could help my investors to vet this quality investments really, really thoroughly, right? Because what happens is there's so many platforms, CrowdStreet, for example. I mean, you see that's numbers, 20% IRR or, 25% IRR. And people quite often send me those investments saying that, what do you think about this? And I say that I can't tell, because when it comes to due diligence, and this is why I like your group, right? Because you guys do certain things certain way, very diligent about your things. And I like to do due diligence on group like you, because anything that I need, you will provide that information, super transparent about it, underwriting, anything I need that you guys will immediately provide. So that's the information that you need to see that this is not shiny numbers, and I call it the shiny object syndrome, that the numbers could be anything, but what are the assumptions? Can they really make that number? That's really, really important. So I like to be that bridge that with the investors, now I can vet these investments. And though it's still not foolproof, they still have to do their due diligence to go on that investment. It's still some kind of scrutiny is done at least, right? And on the operator side, I can help them to grow further by just scaling their capital raise. So that way I'm placed as a bridge between the sponsors contributing to their growth and investors to get that, their hard-earned money on an asset which can actually have a little bit higher chances, higher probability.
That's awesome. So, thinking about that and assumptions and whatnot, do you have any experiences of, numbers looking a little bit fudged or, underwriting not really making sense? Because you said it right there, these are all at the end of the day projections. This is not set in stone. It's a fluid endeavor. It's obviously ever changing, but have you ever seen instances when you go through the diligence process with other sponsors or, people sending you deals where you're just like, what the heck is this?
Absolutely. I've number of times, and people have actually come back and questioned when I rejected their deals and come back and questions that, Madhvi, are you kidding me? Have you seen the projections? And I was like, yes, I have seen the projections.
That's
So
exactly why
here's
I
the
don't like
tricky
the deal.
part. Exactly. So here's a tricky part, right? By the time the deal comes to me, I'm the capital raise partner, right? So by the time the deal comes to me, it's already in the contract. It's already in the process. So, the syndicator team has done their due diligence already, and they think that they can make to these numbers, right? So there is nothing wrong about it. They have gone through like hundreds of properties and underwriting to get to that one particular deal. Now I'm doing and I'm questioning their assumptions. So that's kind of a scrutiny on top of it. And quite often it's, almost 70-80% of the deals get rejected. I have a very interesting story. I had one of the deal which was projecting 2.5 to like 2.8x in 5 years. And within 10 minutes, I responded back that, hey, I just, this just not working out. And they think that they're doing conservative assumptions. For example, during COVID time, the rent growth was like outrageous 7, 8, 10%, right? So they were like, the CoStar says it's 10% in this area, and we are doing 8% rent growth. So that's conservative. That's super conservative. That's 2% less than CoStar. But no, that's not conservative. If you are looking at, almost, what is going to happen next year, that's what you're going to look at, right? So that's an example. And that person asked me that, did you see that how much money you are going to make? And that's the most tricky part, that we should not fall as a capital raise that what's our money, what's our gain in it, but we should always, always put the investor first. What is the likelihood of them making those returns? What are the assumptions? Are they super conservative? Because I mean, this, Craig. If you have 3% rent growth and you have 5% rent growth, it can suddenly jump so, and the numbers will look so good, right?
Well,
So
the
that's
scarier, yeah, the scarier function to me is like cap rate assumptions and exits there. I mean, that's
exactly.
crazy. And expense ratios, right? If you
Yeah,
change your cap rate by, 25 basis points or 50 basis points or
it
even a
just
whole,
shorts up.
it's ridiculous the way it can go up or down. So, and then also not to mention if there's even sponsors that only have sensitivity charts in their underwriting, it's well, I want to see what worst case scenario looks like just to see if my money's safe or not. Is there actually any value creation here?
Yeah, and spot on it. That those are some of the assumptions which even like a small assumption can cause such a big dent in it, right? Cap rate expansion, for example, how much expansion are they doing every year? And this may seem like a lot, small, but this can have a bigger impact, right? So those are the things that I'm really, really particular about. In fact, I have created over the period of years a 200-point checklist for a due diligence, and that level of scrutiny needs to happen even at a capital raise perspective. So any person who is listening to this, don't cut corners on your due diligence. If you want to have one takeaway from this episode, the due diligence, guys, you got to do that due diligence. You got to do that due diligence again and again.
So I have a question as it pertains to that 200-point checklist, right? So naturally, crossing my arms here as a sponsor, I'm like, well, wait a second, is that for every single deal? Or is a lot of that 200-point checklist kind of a front-ended exercise to make sure that, the sponsor and the capital raiser have kind of back-ended questions where, hey, how's property management been? How's, all of kind of the inner workings of your operations been? And is that kind of half those for, a one-time kind of questionnaire, or is that 200 for every single deal?
Great question, Craig. Actually, I'm gonna step back a little bit and provide a little bit insight on the thesis behind it, right? First of all, I don't think that the deal starts with the investment. I think the deal starts with the sponsor team. you got to wait your sponsors first, because a good sponsor can has the ability of taking a mediocre deal and make it successful, and a bad sponsor actually has a tendency of taking a really, really good deal and go down the drain, right? So
Yeah.
for us, the sponsorship team is the prime importance, right? So a lot of stuff is about the sponsor team. So you're absolutely spot on that there's going to be some huge chunk of percentage of that 200-point checklist that's going to be about the sponsor, what their track record has been, what, I mean, about their team, how long they have worked together, talking to their investors, interviewing their investors, especially people who are investing with them over and over again, or people who is not investing on one of their latest deal, because they're going to have some insights to it, right? What their thesis has been, what is their typical underwriting structure is. And once you kind of get to know a lot about their thesis, how they acquire, what's their acquisition process, how's their management process, how is the asset management, is it vertically integrated, how are they renovating these apartments, is it coming in and doing a wholesale kind of acquisition of those materials, etc. So that's a lot kind of a front load to it. And then there is also like a property level, the market area, the property itself, the property rent rules, the underwriting itself, right? So it's kind of a combination of it. And that's why, again, going back to what I said earlier, I'm a very people's person, right? When I started think outside the stocks, it's about people, it's about connection, it's about deep roots that we want to establish and want to grow, help your family. It's not just about one-time investment that you do within think outside the stocks. Similarly, with the sponsors, also, I'm like that. It's about the deep-rooted connections, and that's, I mean, we have been talking for such a long time. Just understanding what you do, how you do it, and in terms of investors, whether you put your investors first, how's your investor reporting, there's so many different level of things that we can take a look at. And once we understand that, now we have a thorough understanding of the sponsors, and now we want to create that deep rooted connection, and that's what it is about. So the delta is going to be the small, it's just about that market level or just the property level. But a lot of thing actually is about understanding the sponsor team, their thesis, how they structure debt, how they do their underwriting, what the assumptions that they have. And typically that's what we see repeating throughout.
I love that. And that's so detailed and thorough there, which is super special and I think very valuable as, one is looking to make the right investment. And also it's kind of a smokescreen test too, to a certain extent, because I'm sure a lot of people, if they see a 200 question questionnaire, they're probably like, okay, thanks, but no thanks, not worth our time,
Yeah.
and not
Yeah.
actually seeing the value of creating a relationship and also seeing the two-way reciprocity that's going on there, right? So,
Yeah.
especially with the capital raiser right now, the value is basically picking winners. Well, if you're not willing to, go through a couple of hoops to be in receipt of my equity, well, then we're just not going to be a right fit. So I love that, a lot of people probably vet themselves out of the process by not wanting to participate and kind of come into your frame there to be in receipt of, kind of going through that process. Have you found that?
Yeah, absolutely. And I'm over the period of time when I would ask these questions as a single capital person, capital raiser, and they would come back and say that, so how much are you raising again? I mean, why are you asking so many questions? Maybe it's not a right fit because you're asking that many questions. And my response to that would be that it's not about how much money I'm bringing to the table. It's about me thinking about my investor who's putting their hard-earned money to the table and bringing to these investments. That's the kind of due diligence that I want to do for my investor, even if it's a one investor coming in, right? So it's about putting the investor first. So if somebody who's responding to me saying that this is not worth my time to answer your questions, they're obviously not putting the investors first, because ultimately, whether you are a sponsor team or you're a capital raise partner, your investor has to come first. The investor has to be the first. And that's going back to what I said earlier about you guys, that that's what I love about Lone Star. And you and Rob has created such a great environment of just the processes and how you are with the capital raise partners too, and respond to their questions as well. Trust and transparency has been the pillar of Think Outside the Stocks and even now Connected Capital. And that's the kind of values that you guys reflect and ooze, right? When we asked you for example, when we asked about like a sponsor due diligence, and it's like, oh my God, it's like a 20-point checklist probably. Overnight, we got a response back from you guys. Before even we asked you, you have like the entire data room open for us to do the due diligence, which has nitty-gritty details of this investment. So that's the level of trust and transparency that we want to build on. That's the level of scrutiny that even on the both sides, when we agree, we know that our values match.
I think it's really special. And, the way Rob and I look at the world and kind of the lens perspective, this is why we're so aligned in many respects, is because we know that we're going to be in business forever. Frankly, like, we don't plan on doing anything else. And, we're both obviously in our 20s, so we're young. I'm hanging on to my 20s with my dear life. I turned 30 here coming up in June. But with that said, we're going to be in business for forever, right? Or that's what we
Yeah.
aspire to do. So for us, it really does make a difference if you choose to invest with us today or in 4 years from now. As long as we're kind of moving the relationship down the line, as long as we are kind of continue to be corresponding with one another, we know that over time, assuming that we hold up our end of the bargain and it makes sense, that we will be in receipt of wanting to, or having you and your people want to invest with us in our deals, and we will earn the business and the respect over time. But we just look at it as wanting to chip away every single day. And if you have the long term mindset, these short term questions are a moot point and are very, very minor in the grand scheme of things. So that's kind of how we see the world. And no question's a bad question. And sometimes I understand this, and I do this too on my end. When someone's selling me something, I ask the people kind of sometimes a silly question just to see how they answer it. So if it's a really technical question, that's great. And if it's even like almost a perfunctory, silly, throwaway question, the response is still super important one way or another to see how someone responds and reacts to it. And it's definitely a red flag if someone's going to get annoying or testy by raising the money there. What that kind of tells me is that they're coming out of a place of scarcity and needing the money, as opposed to and maybe not even having enough equity sources on the front end to close their deal if they're not willing to go through the question process. So, those who have abundance and look at long-term gains and plays realize that this process is actually very justifiable and also necessary on both ends. So, I really like that. And I think the most important thing too is we want to be in long-term relationships and mutually beneficial relationships, and for it to be a win-win-win. And it's hard for that to feel accomplished if you don't feel like you're getting all your questions answered, or if you feel like you're rushing into something.
Spot on, spot on. And that's why we are in alignment, right? Not everybody, by the way, thinks that way. So it's really commendable. And that's why we are, very we are being very picky about who we want to work with, because all those kind of red flags that you mentioned, I mean, it's spot on that that is what we are looking at. We are looking at that deep rooted relationship, because we do want to grow together, and we want to again, going back to what I said earlier, go back to keeping investors first, so that we can have justify what our investors needs are.
Yeah, and I always think about this as well. And this is kind of an interesting conversation that we're having, and then we'll segue into connected capital because I think it's teeing it up perfectly. But similarly, if the sponsor's only thinking about what my promote's going to be, if the capital partner, the fund manager, co-GP, or whatever the medium is, the allocator there is only thinking about what's in it for them and what returns they can make on the front end, it definitely doesn't send me the best signal that they care most about their investors. Of course, we're all in this to make a buck, but at the end of the day, it's super crucial, in my opinion, to make sure that all interests are aligned there. Everything has to be market. Competition will kind of keep you honest there. But it
Yeah.
is interesting that how people phrase and care about their business or want to set things up. It's certainly slightly concerning, but that segues me into the important items I really want to get to now that we've got the incredible foundation set up, which is, of course, the need for, the fund to fund model. But before we get into that, I really want to learn more about the Connected Capital Group, the inception of it. This is a group that's catching wind within the business and is really getting some great tailwinds and is only blowing up and increasing seemingly at a very quick clip right now. So tell me about Connected Capital, the inception for it, and all that good stuff.
Now, this topic is very close to my heart, Craig. So you have touched a really good nerve there. So connected capital, right? So why connected capital? So again, going back to as a my role, capital risk partner, right? Quite often when I saw that, typically in conferences or, anywhere else, I would meet different people. And if it is a capital risk partner, they would want to meet either investor or a sponsor, right? There's a lot, there's a lot we could have done together, but it doesn't seem like it. And then, 2023 has been really hard for many capital raise partners. And I realized that being in different masterminds, different groups, being in different conferences, right? What happened is that when I started thinking about that, everyone is kind of suffering in silos, right? So that's number one. Number two is when I'm talking about this humongous due diligence that I was planning to do, the 200-point checklist or more. How much can I sustain if I want to do this due diligence over and over again and scrutinizing these deals, right? So if I have, say, 10 deals on the table, and which would happen at times, at 10 deals on the table in a week, it's humanly not possible even to do one due diligence thoroughly, right? So there is that problem. And then the second problem is that, with the fund of fund model, and we will talk about the fund model soon, which I wanted to go away from that being a co-GP because, just wanted to keep it purely kosher when it comes to SEC regulations, right? So I found my fund, and as a fund of fund partner, it was kind of difficult because if you have that threshold, that pref kind of a class, and if you fall a little bit short, like 50K or 100K short, then you have to go back and talk to the sponsors. Sometimes they will say yes, no, and by this time I've already raised so much money in that deal. So that was a challenge that was being faced, right? And the third is that, at that level of, going away from the co-GP platform and becoming a fund manager, everything was coming as a promoter. So the challenge was that it was difficult to keep lights on, to kind of have something ongoing, right? So some kind of negotiation needed to happen. And at that level, that negotiation would not happen. And it is trying to help the sponsors understand what our challenges are, right? So we had that vision, and me and my partner Bobby, we connected on that vision. We talked about it, and that's when the Connected Capital started. It's about getting all the capitalist partners together who are facing this same kind of challenges. And now I cannot do the due diligence on the 10 deals, but 10 people can do the due diligence on one deal, right? So now we had that vision that let's come together. First of all, the deal sourcing is important, right? If I'm connected to 5 great sponsors like you, and I have the connection and I can bring in those deals. Imagine 10 other people connected to 5 other really high quality deals and high quality sponsors. Suddenly, the sphere of influence gets bigger and better. Number two is that due diligence. Now we can divide and conquer. The 10 people can do due diligence on one deal easily. So that's what we do. We divide and conquer. The next thing is now we can commit as a together, a connected capital together, so that we can raise that capital to the minimum or even like 2 million, 3 million, whatever that category is. And then we can go back to sponsors, tell our challenges, say that, hey, this is our challenges are, can we negotiate it a little bit better, right? So that way, as a capital risk partner, they are getting the best out of it, of this group, of this connection, of this family of capital raisers. And at the same time, for the sponsors, it's becoming easier in two ways, right? Suppose we have 10 fund managers and they have to go and like, this is like about how many coffees and how many webinars that you could do as a sponsors do, right? So you as a sponsors now can come and present to, I mean, you were on, we have about 50, 60 people live on the call out of like 300 plus members already in the community. So that way you get to present, and these are not the retail investors. These are the capital raise partners, fund managers who has their database of their investors and the back end, right? So now it's so efficient for you to come at one single point, present there, have one person, one deal lead, who can get you through the entire due diligence process, the capital raise process. And number two, that now if we can scale this together, the raises together, now it contributes to your growth, that now you can do bigger, better deals and faster deals, hopefully, as we start tying these hands together. So that's the premise, that's the thesis behind the connected capital. And again, going back to that people's kind of person that I am, and Bobby even is, that it was about making those connections, making those long-term relationship of the capital raise partners, growing as a family and getting to know each other, what our pet peeves are, what we like about, in the life. So that's the kind of family that we are building with Connected Capital.
Well, I've been very impressed with the members of it. And you said you have 300 members now of the group. Is that correct?
Yes, we have about 300. And, trust me, me and Bobby, when we started with this vision, we thought that let's get handful of fund managers who can do the due diligence together and raise capital together. And we were like, okay, let's just do it 20, so that, it kind of a mix and match. Not everybody wants to go on a particular deal. So at least we'll have 3 to 5 fund managers who will be willing to go on a deal together, right? uh, it was every other week that we were meeting, and that was not enough, and people just started flooding in, and that kind of explains me that there was a need for this kind of group and this kind of community. So we are now meeting every week on Friday. We call it a Connector Capital Friday, very resemblance with your name. But yeah, I think that's what the beauty is. And we hang out. It's a 2-hour call. We have sponsor presentations. What happens in the meetings is quite interesting, actually. After the sponsor presentation is done, we request them to respectfully log out, and we do the behind the door, the closed door talk, where we talk about the sponsors through the grapevine. If you have heard about the good, bad, the uglies of about the sponsors, and then we talk about the deal itself, that hey, this is what I think I'm comfortable with, this is what I'm not comfortable with, and then we decide that let's go into due diligence together. So when we have at least 5 people kind of signing up for the due diligence, we go ahead and do that. So that's the beauty of it. And not just that, it's not just about the presenters. By the way, behind the scene as well, there is a scrutiny that's going on. So we have that 200-point checklist for the due diligence, but before even the presenters come in, we have a small kind of a 20-25-point checklist to screen those deals. So it's not just that something comes to the desk and we bring it and say that, oh, okay, you can go ahead and present it. These are the pre-screened deals as well. So that's a good deal flow that's coming in. That's very important to note, because what happens is that, I'm a part of masterminds, I'm part of like WhatsApp groups. People generally post their deals and it's kind of a flashes. And if you're not following that kind of flow, you kind of lose that. Even some good deals can actually be lost in that flow, and you don't know if it is worthy of doing the due diligence or not. But when actually good sponsors and good deals like you come and present, and we get to ask those questions. And I mean, you have noticed, right, these questions itself in the room, these are from the expert capital raise partners. So these are really, really high level, advanced level questions. These are not your retail investors or basic like preliminary questions. So just being in the room, actually just listening to it and what goes on, you get to learn a lot. So that's the kind of an environment that we are cultivating. We are also bringing a different kind of education, different kind of speakers, so that this journey of capital raise, the fund, the fund manager, that becomes a little bit easier as well.
Yeah, well, a lot to unpack there, and thank you so much for breaking it down. So, I think it was first, your group, I should say, was kind of first forming around maybe Raise Faster's retreat in New Orleans. And to see the growth from maybe a couple people there to 300 people now is really inspiring to see the lightning that group has really captured. So congratulations on the exponential growth there. It's really impressive. And it's something I think about real estate in general is I've felt this way before being in residential sales and just being in the business generally. You can really feel like you're on an island and there's no team or support around you, and you need
Absolutely.
confidants and people to collaborate in the space. So your option there, your group definitely allows for that. So I definitely think it's really special there as well. And then I also think it helps to have, some people, or having such a big group of people in your group is really beneficial because the space that we're in is very small. Everyone, one way or another, will know everyone. Everyone kind of has the gossip one way or another. Not that it's a gossip hour on the conversation, but if
Yeah.
one does not treat someone correctly, if one is maybe dismissive or just isn't the most respectful, that will obviously come out in these meetings. And that's very important because how you do some things is arguably how you do everything, right? So how you treat people, things like that will come out and that will be discussed. And there'll be a lot of
Yes.
blinders helped for some people who are maybe newer in the business. And if you're newer in the business, what's super crucial is you get to learn how people with probably cumulative over 100 years of experience are looking at deals, analyzing deals, closing deals. And these are people that have probably raised money for opportunities that maybe have lost money, or maybe they've lost money in their own
Exactly.
investments. So you're getting that brain trust there, which is super valuable. So if you're newer, that's really crucial. But the other thing that's really great about Connected Capital is, let's say if you are a emerging fund manager, right, and you have no track record, you can kind of waltz into this group and maybe contribute $100,000, $200,000 as you're getting your fund managing career going, where it's a lower pressure environment because you can kind of latch on to the group's raising efforts and then get that going, have some wins, have something there that will help create more momentum in your business to get you a track record to be synonymous with the other sponsors and groups. So I think that's immensely valuable for anyone's in the space. So this is just a PSA. And if you're an emerging fund manager, capital raiser that's not really part of any groups, masterminds, this is a great place to go. And forgive me if I'm
Absolutely.
wrong, but the price point is very reasonable for someone to kind of join. Isn't that correct?
It is actually, Craig, and I'm going to touch base before I talk about the price a little bit more about what you said because it's so crucial, so important, right? So yes, it has been a great progress. We actually launched Connected Capital right after fund launch last year, so around May, June is the timeline, and since then we have picked up so much momentum, right? So one of the things that you touched base is that when you're going in the deal, and if you go in the wrong deal, or you just have your investors' money on the line, right? So as my, as our mentor Hunter says, that there is kind of a slogan I have in mind is that the best deal that you do is a deal that you don't do, right? So when you hear about that through the grapevine and like that gossip section, as you say it, but that's behind the closed door conversation. That is so crucial. That's important because quite honestly, Craig, we have rejected people who has great reputation, but we don't bring in and have them present because of this grapevine and because of this conversation and how people talk about, they have just either lost their money and not done up to the mark when it comes to their investors and keeping their investors first, right? So it's not like we are blanket that we just, okay, anybody comes in and you can present. We have even known with really good reputation, we have rejected those sponsors that no, you cannot present to our group because we don't want that kind of coming in. So that's really important. The second thing that you were talking about that's really important too is that's an emerging fund manager. I have been there, right? I have done the capital raise for the first time. And trust me, the first capital raise is the nightmare, is a
It's
nightmare.
clunky.
It is. So many sleepless nights. And I was like, I was so afraid of things that it's not going to happen. And it didn't because, I couldn't reach to the mark that I was supposed to reach, which is always challenging. And with that, I didn't even get paid for it, right? Not only that, the worst thing is I lost my investors to the database, right? So they started getting all their investments later on. And I kept saying that, okay, can you remove this investors from your database? And they did. And then again, it will pop up after 6 months or a year, right? So that keeps on happening. So that's why the ethics and the values are really, really important. But now as a fund of fund manager, I protect that, both of those, right? So first of all, with connected capital, we are solving that problem. Trust me, there are people who are beginners, they're like raising like the lowest amount, but they're still getting the exact same split as person who's raising $1 million on the same deal. So that's the beauty of it, that number one, that challenge is taken away, and then number two, that now as connected capital together, we are bringing that bigger check size together, so you're getting that split. And number three is, as a fund of fund operator, by the way, this is a very crucial thing, you are giving one check to the investment. So you're going, for example, my fund is think outside the stocks diversified. So my fund is one check going in. Lone Star will never know what my investors are inside my fund contributing to that investment. That is really super important. So even if you're still thinking that, hey, CoGP model has worked well for me for years, I will continue. First of all, it's not kosher when it comes to the SEC point of view, because even if you're doing the investor relationship, how many people one investment needs to do the investor relationship, right? So stay in the white lines. That's number one. Number two, that you're not going to lose your investors in the fund of fund model. So that's really important for a partner who's still on that kind of a boundary line, that I want to continue doing the co-GP because it has worked for me for so and so reason. You actually can get the same dynamics when it comes to the economics of the fund, and we have calculators that kind of proves that you can sometimes get even better dynamics, right? So that is what you should keep in mind. And if you're on that verge of changing, think about it, and you can always reach out to me. I would love to be, happy to answer any questions that you
Yeah,
have on
and
that front.
we'll obviously have in the show notes and at the end ways people can find you. And obviously, my emails are always open, and I'm more than happy to connect anyone to Connected Capital there. A lot of connections
Absolutely.
being made today, of course. But I really just can't underrate the value if you are new in the space and you don't know left from right, up to down. It's definitely a very confusing and structureless space. So to have kind of a group of people to shepherd you in the right direction, to mentor you, to help you through the process, to ask the right questions, to get you on your feet, because this is not an overnight success business. This is a business where you really have to grind it out, and it's going to take several years for it to be profitable. Not only is it going to take for it several years to be profitable, but frankly, if you're a co-GP or fund manager, typically speaking, the structure of these deals are, yeah, you get maybe a little upfront fee here to kind of keep the lights on, to kind of have the fund be self-sustaining, but your big bucks come at full cycle. And full cycle right now in a market like this is probably looking like 4 or 5 years. So it might be
Yes.
4 or 5 years, you maybe even 7 years before you actually kind of realize the returns and kind of get that incremental bump there. So, in the meantime, to build that space up and to get a track record for when the market is hot again will only be valuable. So there's so many angles to approach this, but from a fund manager's perspective, to kind of expedite the process and allow you to get exposure in a lot of deals and to allow you to make sure that you pick the right winners, work with people here who are doing a lot of the hard work for you that you can kind of, hitch your wagons to, where, everyone's collectively kind of carrying their weight and is lightening the load. It's kind of like, hey, one group coming together to create one kind of private equity fund together is effectively what it is here. So it's super valuable in that respect. And is really awesome because the fund management process and the fund setup is not really a cheap endeavor, which gets me to the next topic,
Yep.
which is the fund to fund process, which a lot happened in hindsight looking back at the New Orleans conference that we were at together, of course, for Hunter's group there. But can you kind of walk us through and why the fund to fund SPV process now is so common? Because seemingly at around August, I want to say, was when it really kind of came the hot question that everyone's reaching out and asking us. But seemingly, you mentioned around May for fund launches when this group started. So I'd be very curious to kind of hear in to your eyes what the fund to fund journey and process has been as it pertains to the real estate world that we're in currently.
Absolutely. And I was, mentioning some of these things that why fund of fund is important for the co-GP, right? Or the capitalist partners, but it's also important for the sponsors too. So very organically, what has happened with Connected Capital that we are actually become the, organic educators of this really good sponsors who has not done this before, right? So the understanding the nuance of the fund of fund and the creating the class, creating that preferred class, whether it's 500K, 2 million, and different layers kind of statistics to it. So that is what is crucial, right? There's something, probably the due diligence fees that comes up front. Not many people think about it that way, but that's really what helps us to keep us light on. And also, the back end, when it comes to the splits, if the fund manager can very clearly keep some kind of a back end and give the terms to the investors, our logical point always is that if the investors go directly to the operator to that investment, they should get the same thing that as a fund manager in my fund that they are getting, right? At least similar or a little bit better at times, right? And that does happen. So that's really important. So operations on the fund of fund side is kind of staying on that white lines for both operators as well as the fund managers or the capital risk partners. And that's why I like it. I became a fund manager in end of 2022, and I started, on a platform called Avister. But really, Connected Capital is platform agnostic. You could really do anything. What we are adamant about is that this is not going to be co-GP. This is going to be a fund of fund model. And the beauty of it is not that we are creating Connected Capital is creating one SPV fund of fund, because if we do create that, then of course Connected Capital will retain some kind of portion of it. That's typically what people think about it as that, okay, they're just creating an SPV and they're coming in together and keeping some on the top. No, if that investment is there and it has created that structure, we are going as a separate checks. So if you're a new partner, you're a new capital raise, and I'm also going into the investment, our splits are going to be the same. So that's how we have structured it, and we're, very particular about it. What's important to remember that it's together, but yes, it's independent, right? So our slogan is race together, grow together. At the same time, it's together yet independent. So, say for example, you participate in on a due diligence and Connected Capital, we typically have a go no go call. We discuss everything on the table of different areas, and you still don't feel comfortable even if Connected Capital as a group we said that okay, 5 people, 10 people are going to raise on this, you can still step back and say that I don't want to raise on this because it's just this one particular thing makes me uncomfortable. So it's together, but it's independent. You are making your own decision. And when you make that decision, you're going independently in that. Going back to the fund of fund model, right? That's being a fund manager is not easy. It's not just one create one LLC and be done with it, right? The beauty of it is like I have kind of a customizable model where my investors can pick and choose their investments. They don't have to go on all the investments blind pool, and I give one K1 at the end. It is a beauty of it, but it could get really complex too, right? So that's important for investors. They get one dashboard, they get kind of look at everything in one login, and they don't have to go to like 5 different portals because if you're a co-GP, you could have 5 different portals, right? Or if you want to create just an SPV, something like a TribeVest could be a way to go. Or Rice 48 also has a platform fundamentals coming up, so you could literally do go and create anywhere that you want. But the important thing is it's a SPV or the fund of fund model so that it stays kosher in all the ways.
Yeah. Well, and I think you mentioned something there, which is, if you create the fund there, I know Avestor has a setup there where, you have that all in house, all one spot there. And a lot of investors get portal fatigue and aren't wanting to go through that process. And also, the layer of separation is really special with the fund to fund process because it's just one check. We don't see individual information coming in. We look at any of their
Yeah,
data, which is really valuable. And that for a sponsor like us, it matters because we always marked, investors and where they came from for crediting, of course.
yeah, yeah,
We're never trying to circumvent anyone, but it really does create a layer separation that is very beneficial.
yeah. I
So
would I
that's
would
something to
say
think
one
about.
thing. I would say one thing. Not every sponsor has high values like you, and that's why why we like you, and why that's why we are getting into this relationship of you being as a sponsor, and the sponsorship with Connected Capital, because we are very picky about it. We are very picky about the values and the ethics, and you really have really high ethics and values,
Well,
and
to
that's why
start with
this.
that, as well, just regard to ethics, sometimes Rob and I get not frustrated, but it makes us think twofold. How much of a shame is it that people with their antics, maybe because they're a little bit older, they got a little bit longer of a track record, maybe they started buying deals in 2014, so they had a little longer run up, they maybe have gone full cycle more deals. How some
Yeah,
people can raise money for opportunities where they carry and conduct themselves in a very unprofessional manner or are a little bit slimy, to me makes me sick to my stomach. But on the other end of the spectrum, once we do have a little more of a track record and we're a little bit more built out and you get incrementally better, how much easier our lives will become every single
it
day
is.
by putting the work in right now. But the fact that people can raise money under that frame is really interesting to me, but it will not last long forever, in our opinion. And, water always finds its level. And when,
Yeah,
the tide comes in, we'll see who has clothing on or not, as the saying goes, right? But going on to the sponsorship, so I definitely wanted to kind of solidify even more so our relationship, of course, because we are, in fact, one of
yeah,
the distinguished sponsors. I believe it's us and Rise 48. So great
yes.
company for us to be in there. But kind of walk us through, what it means to you for a sponsor to be here, the significance, the importance, because if I'm not mistaken, you kind of hand selected us and we obviously jumped at the opportunity right away naturally. But can you kind of tell us
Yeah.
about, what it means to you and, your gatekeeping process pertaining to the sponsorship and, how important it is?
Absolutely. And again, going back to that kind of a deep rooted connections, right? So values and the trust and transparency is number one, right? We are very selective about sponsors. It's not like, I mean, people have approached us that, hey, I want to be sponsored, but we are very selective about it. First of all, that value system, that's number one. Secondly, the track record and what you have done and how you have faced the different challenges. Because, hey, we have seen so many challenges in the market, right? Then when you have your kind of a ground rules about how to face those challenges, And if you have that capability of navigating those challenges, that's what drives, right? Because trust me, every different cycle is going to have a different challenge. Is the ability of the sponsorship team to stand behind it and navigating those challenges. Again, putting the investors first. If they cannot navigate that challenge, then who are we going to ask, right? So there's certain things that we do go through, and we have some kind of checklist points that we do look at. Vetting the sponsorship, because sponsorship is not just one of that. You're going to come in and just present to us, and then if we decide to go due diligence or do capital raise, and kind of go away from that. But sponsorship is a more of a commitment. It's a commitment from our side. It's a commitment from your side. One of the things that really stands out with the Rise 48 and also Lone Star is that your commitment to educate. Right, education is the first fit forward always, right? Whether it comes to think outside the stocks, whether it comes to connected capital, we have run this community free so far. I mean, you're talking about the price point, right? We have completely free community so far, and in fact, just last Friday is when we launched our membership model, right? It's about the value, it's about the education, the willingness to do it. So you have already provided ton of education, and that's another aspect that we look at. We want to grow with you, and we want to have that, what you say, that you are in this for long term. Another aspect of it is really important, is that we as fund managers, when we have the funds, we want to diversify in different asset classes. A lot of us have expertise in multifamily, right? But when we start going into the self-storage, mobile home parks examples, so many different asset classes, we want the really truly best in class operators and partners, right? And when it comes to sponsors, we are very selective again above that, right? Because if we can't be that expert, you are the experts. You take your job so diligently. You are in this for really long term, and that's what we want to see. So that is where a lot of our scrutiny comes in, when it comes to just overall values and really that go giver ability, right? The go giver book is like kind of my Bible, and I'm driven by that. It's not about how much money you make, really, Craig. It's about, number one, what problems that you solve for people who are involved, and number two, how many people that you solve that problem for, and how much is that impact, is that's humongous impact, right? Whether it comes to connected capital, whether it comes to Lone Star and you individually impacting those investors, those families. That's what we are here to do, and that's what we are, the impact is what drives us together. So hopefully that makes sense, and we are so excited about this partnership. And thank you again for being jumping on the board with the sponsorship again so quickly. Hopefully you did find that value, and you find that what our overall ethics are with connected capital worthy of your sponsorship as well. And we look forward to actually see a lot of growth together.
Well, and that's the thing. It's growth together. And it's also, at the end of the day, this is a farm system to a certain extent. If you want to think about baseball, you've got the minor league players, you've got the big leagues, you got this, you have that, right? We know for certain, you just don't know where, but whether it be Hunter Thompson's group, whether it be Rod Khleif's group, Jake and Gino, there's a ton of groups out there, right? Of course, Sam Silverman's fully funded group. There is going to be a rising star and an all-star and a superstar in that group. And you don't know who it's going
Mhm.
to be, and you don't know what group they're going to be in or where they're going to come from. But
True.
somewhere or another, it's going to be there. Like, for instance, Gib Irons was just a guy wearing a collared shirt, Raise Fest in Louisville. Now this guy's raising millions upon millions of dollars, suited up, and
Exactly.
has got all of his infrastructure in place. He was kind of just a spectator the year before, but he knew he wanted to get into it. Now he's a bona fide badass, which is super cool. But my point there is not to just name drop him, but great can come from anywhere and will come from somewhere. And we are very confident that there is going to be someone who is going to be a shooting star within your group just on that level. But then, of course, there's so many groups, like people like Jeff Greenberg, for instance, who's been, a fund manager for such a long time, or Johnny Walker's raised for our deals. We want to only enrich relationships with Johnny, but it would be great to get, Jeff, for instance, we've never raised with before, maybe in one of our opportunities where maybe this now will put him over the edge to, kind of position ourselves to work with him. And there's so many other great people, just to name a couple right there. But there's so many other special people within your community that are there for us that we haven't worked with. So there's obviously a mutually beneficial interest there that we all can kind of collaborate there, as the market ebbs and flows. But you just never know where your next equity relationship is going to come from. and just, who we may help along the way. So I think it's all about community and cross branding and sharing best and practices and business practices. So I think it's a no-brainer on our end. We're always looking to, find new relationships and partnerships. So it was really a slam dunk.
Yeah, absolutely. And, I think it just goes back to, again, the basics is with the growth, it doesn't have to be compromised, right? So we can grow with the right mindset, right people around you, and that's what both of us are aligned with and growing together. I think that's really important. With connected capital as well, it's very difficult to run that ship because there are so many difficulties in getting people to agree on working on the same deal because they could be, hey, I don't want to be in a multifamily, I don't want to be in self storage, so there could be different challenges there. We're navigating that. Bobby and me has been spending a lot of time in connected capital. Like I said, it was a free run community so far. We have gotten into that model, but there behind the scene there is a lot of people that are working really hard. Matt Shields, Leah, JP, there's so many people. Jeff is kind of that core group. We call it a huddle group. Kent and Johnny, and these are the people who are vested in success of this group and success of other partners. Like you said, that rising star could be anywhere, and we want to create many of these rising stars through connected capital. So that's what the premise is. Going back to your previous question, and I'll answer that now. The price point, we have kept it very simple and affordable because we do understand the challenges of the fund managers of platform fees and creating the fund and joining other masterminds or whatever money that they have spent so far. So there is still a lot of free. You could still join those Friday calls, free, connectedcapital.fund. You could just sign up for the membership there, where you get that pre-screened, really thoroughly vetted that deals that are coming in, that you can still, the deal flow is very important, high quality. You have like levels, which is $100 per month if paid annually, $200 per month, or $300 per month. So that's the gold level, is the $300 per month if paid annually, and you basically get to participate in all the due diligence as much as capital raise, no cap on anything. So we are there at this point, and we just launched it last Friday, and we are almost the first 10. So after the each 10, we will slightly increase the price. So, that's kind of where we are. Uh, we will try to keep it more affordable as well as kind of adding more value so that we can, keep on adding this, building this infrastructure. Because what happens is that number one, we do need the high quality fund managers. So if you're raising capital and you're there about $1 million or something, those are the kind of people. Once we increase our check size, for example, if we get to that point where we can raise 3 to 5 million, or at the next level, the vision is that take the complete entire capital raise taken care of for an operator like you. That's the vision that we want to go to, right? And then different asset classes as well. So growing to high quality fund managers as well as growing with the high quality sponsors in different asset classes is what framework that we are building. And of course, with education and the tremendous support, probably common tools that we can utilize together, probably have some marketing and CRM support, something that we can provide, kind of a growth model. That is what we are looking for capital raise partners.
Yeah, well, and I think just for all those people like, oh, great, another mastermind, this, that, this is not another mastermind. This is totally different. This is actionably sifting through deals, live reps, opportunities to raise for deals, to bring your capital to the capital stack, to be a part of something there. And the price point obviously indicates that this is not to compete with the Hunter Thompson Raise Masters, the fully funded, Rod Cleave's group, Jake and Gino's, all the groups out there, right? I don't need to list all of them
Yeah,
out, but you
yeah.
get it, right? This is just an ancillary item. Oh, my mic's moving on me. This is just an ancillary item to bring to your tool belt to help you absorb, comprehend, and to even get onto new sponsors lists and to work with people like us and other great people in the business. So it is really not to compete there. It's actually very complementary. And I think it's the missing link, which is putting people together that might maybe not know each other and to collaborate together that the other groups don't have as much per se. And also, by the way, if you're a really legit sponsor, by the way, here's a group of a bunch of fund managers. So reach out to the one and only lady right here. If you're looking to raise equity on deals and you're looking to find new sources, this could be your gateway to meeting new people. With that said, you've been such a great guest. Where can people find you, and will you be at the Best Ever conference coming up?
Yes, I will be at the Best Ever conference as well as the fund launch as well. With connectedcapital.fund, if you are a capital raise partner or you're a sponsor, just access us there. If you want to submit a deal that needs to be presented for the equity raise, we are there. Or if you want to join as a member and just join and try out the free level, just see what the high quality people in the room. It's just such a pleasure. It feels like a good, like a friendly hangout every Friday. It's my commitment there. It's instead of going and having lunch with somebody else, is this group, this family, just we come together, we hang out for a good afternoon. So connectedcapital.fund, remember that, just sign up there. One thing that you mentioned, I really want to reiterate that yeah, this is not a competition with other, kind of groups there. This is actually very complementary. And as Bobby and me say that this is where the rubber meets the road. This is where actually fundraise, that capital raise actually happens. This is where, and that's why we have gotten so popular so quickly, because this is one of a kind. This is kind of a niche that people lack this, and where we all are coming together and a tremendous amount of discussion and problem solving happens. People don't even think that this was going to be a problem, and suddenly like somebody says that, oh yeah, I was just doing everything SPV, and now I could do something like in an investor model, and I can just do a small raise too. I don't have to look at like a break-even point every time I create an SPV. So those kind of stuff, that happens within the group, right? This is the next level mastermind that you have. So it's not just another mastermind that you can come and just do window shopping and attend the meeting. But this is actually where your active participation is needed. And this is what's going to help us grow.
Absolutely. Well, thank you so much for coming on the show. I knew you're going to BEC because, of course, we're going to have dinner one night. We're going to have a group dinner, of course, as we do at the Lone Star
Yeah.
Fashion Way. So if you're going to be at Best Ever and want to learn more, please reach out to Madhavi. And then, of course, we'll be there as well. So we're more than happy to connect and meet and share and collaborate. Thank you so much for being on the show. And thank you so much for listening for everyone who's been here. We'll catch you next week. Peace.